Hi everyone, welcome to today's class. So today we are going to we are still on cost of capital, and today we are going to look at cost of computations and cost of debenture. As we all know now that capital comes in various forms, such as ordinary share, preference share, and debenture. So today we are looking at cost of debenture. Now, looking at this question on the board here, the question stated that Marx PLC has 10% irredeemable debenture in its capital structure, currently quoted at 106 naira. Interest on debt is about to be paid. You are required to calculate the company's cost of debt. So, but before we proceed to solve this question, in explanatory parts of debenture as a form of capital, we have explained that if you haven't watched the video, please check out for the video, cost of debenture. There we explain what debenture is and how the forms of debenture. So let's quickly look at it and let's really define the concept of debenture now before we can start to solve this question, because we need to understand what debenture is and the types of debenture before we can solve a particular question. In the last video, in the past video, I said debenture is categorized into two, where we have redeemable debenture and irredeemable debenture. Redeemable debenture is the type of debenture in which the holder, in which the company can redeem at the expiration of the time in which it was stated in the contract in the first place, when you are buying the debenture in the first instance. In that wise, if the debenture can be bought back from the holder, it means that the debenture is a redeemable debenture. But in the case of a debenture cannot be buyback by the company, it means the person holding the debenture holder will receive interest into perpetuity. Now, you need to understand the two concepts before we able to do what to understand how to tackle, before we able to do what to know how to tackle any question on cost of debenture. Now, let's look at this question. It said Marx PLC has 10% irredeemable debenture in its capital structure, currently quoted at 106 naira. Interest on debenture is about to be paid. Require calculate the company cost of debt. Now look at it. They said this debenture is what? Irredeemable debenture. Irredeemable debenture. But intrinsically, we need to ask ourselves the question: is this question truly irredeemable debenture? What are the yardsticks for us to determine whether a question is irredeemable or redeemable? Irrespective of the examiner putting it there, that the question is what is redeemable or not. In other words, in some of the videos we have done, I said the yardstick for determining whether a debenture is redeemable or not is that we must have basically two things must be present in a particular question for us to know whether the debenture is redeemable or irredeemable. Fine. For us to know if the debenture is redeemable, specifically, let's look at it. For the debenture to be redeemable, there's need for us to have the current date and the future date. Followed by the current date. The current date is the date in which the debenture was bought, and the future date is the date in which they are going to redeem the debenture. That is the redemption date. It's the date in which the company is going to buy back the debenture. Now, looking at this question now, there's nothing stating to us that does not give us the date of purchase and the date of redemption. In this case, if you don't have the date of purchase and the date of redemption, it means such debenture is what? Is irredeemable. In other words, therefore, this question is what? Is an irredeemable debenture question. So therefore, this question is irredeemable. Why do you have to analyze? We need to analyze in order to know the formula to use to compute our cost of debt. In that wise, this question is what? Irredeemable debenture. And also we said if there is tax in a particular question, we need to put in the effect of tax in computation of what? Of the debenture. Because debenture interest, it is what? A tax liable expense. Debenture interest, it is what? A tax liable expense in which you make claim on that before you arrive at the taxable profit. So it's an operating expense, a finance cost. So that is why it is an liable expense. So let's look at this question, let's look at it and solve it. So KD, the formula to use here is KD, cost of debt, which is equal to I, we said I over PD. Then our I is equal to what? Interest. And PD is what? Price of debt. Price of debt. I see debt, I mean debenture. Okay, let's now solve it. So KD, we are required to compute the company cost of debt. So KD is equal to, what is our interest in this question? Camex PLC has 10% irredeemable debenture in its capital structure. So our interest here is what? Is 10%. But the question we need to ask ourselves is what? 10% of what are we talking about here? When we say 10%, definitely it's 10% of it's supposed to be 10% of a particular amount. So it is usually, the nominal value of the debenture is usually 100, is usually quoted at 100 naira. So when you have 10%, it means they're making reference to what? You said it's interest, so it might be what? 10%, the 10% of what? Of the nominal value of 100. This is interest. Why this is what? Nominal value. So nominal value of a debenture, of one debenture is what? 100 naira. So therefore, we will still be having what? 10% of 100 is what? Still 10. 10 is 10, to give us 10. In that wise, so our cost of debt is equal to, that is why we have it as what? 10. It's 10% of the 100 naira is what? Is 10. All over the price of debt. What is the price of debt? They are currently quoted at 106 naira. But before we put it here, look at it again, look at it. It said interest on the debenture is about to be paid. The same thing that is applicable to package value under ordinary share is also applicable to the debenture. When we said under cost of equity, the market value we normally use there is what? Market value ex div. That is market value ex dividend. Likewise, the market value, the price of debt to use here must also be what? Market value, price of debt x price. X end price. X end price. X end price. X end price. I used to say, if, look at it, he said, interest on debenture on debt is about to be paid. That is, they are about to pay, is due for payment but has not been paid. Interest on debenture is about, they are about to pay it. So therefore, the element of interest is embedded in what? In the market value of this what? Of this debenture. So therefore, we need to remove the interest element from it. We need to adjust this to do what? This is market price cum int. So we need to do what? Reduce it. We need to adjust it for what? For interest. At least we need to do what? Remove interest from this market value in order to have what? X int market price. So let's look at it. Adjustment of. So we have 10 here. So let's adjust the market price. Price of debt cum int. PD cum int. While PD, price of debt cum int, is equal to, what is it? What do you have here? 106. 106. What is the interest on it? The interest, we need to remove the interest element on it, which is what? 10. 10. We remove it. So what do we have? We're going to have 96. 96. So the price of debt to use here is not the word 96. So 96. So therefore, what is our cost of debt? Our cost of debt is equal to 10 divided by 10 divided by 10 divided by 96. What do you have? We have 10.4. we have 10.42, approximately 10.42%. 10.42%. So that is the cost of debt in that question. That is the cost of debt in that question, 10.42%. So we have seen that what was applicable under market value on cost of equity is also applicable here. That is, you have to watch out for this. For the information relating to what? To interest. If interest is about to be paid, you need to do what? Remove it. Adjust it for what? X price. Because the price that we are going to use them must be what? X price. X int price. X int price. So let's look at another question on that. Let's look at another question. So, question 2, say Plateau PLC has 8% redeemable debenture in its capital structure. The capital structure currently quoted at 102 naira. Required, calculate the company's cost of the debenture, the company's cost of redeemable debenture. Okay. If one, the company is not liable to pay tax. Is not liable to pay tax. 2, the company tax rate is 30%. Now, looking at this question. Now, it said Plateau PLC has 8% redeemable debenture in its capital structure, currently quoted at 102 naira. Required, calculate the company's cost of redeemable debenture if the company is not liable to pay tax. 2, the company tax rate is 30%. Now, this is a question that involves the issue of tax. And if the company is liable to pay tax, we need to adjust the tax element from the interest. So the part that was saved from tax, we need to do what? Remove it. Okay, in that way, so solution to question 1, the company is not liable to pay tax. But look at the question very well. Say Plateau PLC has 8% redeemable debenture in its capital structure, currently quoted at 102 naira. Now the first question, in any question you want to solve under debenture, first of all determine whether the question is a redeemable question or a redeemable question. Now looking at this question now. The question said, Plateau PLC has 8% redeemable debenture. But truly, is this question a redeemable question? Is this question a redeemable question? Now, what are the conditions for a question to qualify to be redeemable? For a debenture to be termed as redeemable? a question will be termed to be a redeemable question, a debenture will be a redeemable debenture, only if the two conditions are present. That is, there must be date of purchase and what? There must be date of redemption. But in a case whereby the examiner is silent, whereby a question is silent as to the date of purchase and the date of redemption, what are we going to do? We are going to assume the question is irredeemable. Let me take it again. You have said in some of our videos. Watch out for three things in a question for you to determine whether the question is what, redeemable or not. For a question to be redeemable, it needs to satisfy two conditions. The two conditions must be present. If one of them is present, it means it will be deemed as what? Irredeemable. Two conditions must be present. What is the first condition? The condition is what? The question must have what? Date of purchase and date of redemption. Must have the date of purchase and the date of redemption. That is when a debenture will be what? Will be redeemable. Now let's look at it. So therefore, this question is a what? Is an irredeemable question because there is no date of purchase and also there is no date of what? Of redemption. So don't be tricked by this word redeemable debenture. So therefore, this question is what? Is a question on what? Irredeemable because there is no date of purchase and there is no date of redemption. So it's an irredeemable question. So therefore, the question, the formula I'm still going to use is what? KD is equal to I all over PD, which is equal to KD is equal to what our interest? 8. Just pick it straight. Just pick the value 8 straight because it's 8 multiplied by 100, which is the nominal value of the debenture. So therefore, it's 8% times 100 is what? You are still going to have your 8. So it's equal to 8 all over price of debt. When you're looking at the price of debt, what did they say about the interest? Is there any question relating to the interest? All the currency has 8% equity mentioned in the capital structure. Currently quoted at this. They don't give us anything, any information as related to that debenture to the interest. So therefore, we are taking it straight. And besides, if market value will be what will be taken to be used, we are going to use it direct. But it will not tell us whether it will soon be paid or not. So therefore, 8 divided by 102. So you have 7.8%. You have 7.84. So 7.84%. So that is our cost of debt for scenario 1. So for scenario 2, let's say the company tax rate is 30%. So there is tax in this question. So the formula will change. KD is equal to I, open the bracket, 1 minus T, all over price of debt. What is T? T is what? Is the tax rate. Tax rate. So cost of debt is equal to I. What is I? Interest. What's our interest here? 8. Open a bracket, 1 minus. What is the tax rate? 0.3. That's 0.3. 0.3. All over 102. So when you minus 1 minus 0.3 to give you us what? That is 0.7. So 0.7 multiplied by 8. Okay, which is equal to 8. 0.7 all over 102. What's our final answer? Our final answer here is 8 multiplied by 0.7. What do you have? Divided by 102. 102. 102. So we have 5.49%. That's our cost of debt. That's our cost of debt. That is our cost of debt. So that is it. Very simple and straightforward. So just need to do auto adjust all the variables and you have what you are looking for. That is it. So let's quickly look at another question. Okay. Let's look at another question. Set 3. Rooney PLC has 13% irredeemable debenture. Irredeemable debenture. In its capital structure. Which currently yield 8%. Required calculate the cost of the company debenture. Now, Rooney PLC has 13% irredeemable debenture in its capital structure, which currently yield 8%. Required calculate the cost of the company's debenture. Cost. What do you mean by cost? It means the answers to do what to calculate the market value, the price of debt. So what is yield? The yield they are talking about here is the what to cost of debt. Anyway, you can still use the formula KD. You see the formula KD, then tax, no tax. So, I all over PD, which is equal to the yield is what is the cost of debt, which is 8%. That is what 0.08 is equal to I. What is our interest? 13 all over PD. If you don't know, that is what we are looking for, price of debt. So what you have to do? You have to do so cross review or cross multiplication. So 0.08 PD is equal to 13. So therefore, divide by the coefficient of PD. So PD 0.08 PD all over 0.08 is equal to 13 all over 0.08. So this will go with this. So what is it? What is the answer? Our price of debt now be 13 divided by 0.08. So 162 naira. You have it to be 162.5. 162.5. So that is, you can also be required to calculate the cost of the debenture. So that's it. So you can put it there. You can tend to do what, manipulate your formula, but straightforward. Not to stress yourself. Just put it there. The answer will avail itself. To avail itself. It will avail itself. So let's quickly look at a question on So let's now quickly look at a question on redeemable debenture. If a debenture is redeemable, let's look at it. So let's look at this. Aristotle PLC has 13% irredeemable debenture. Irredeemable debenture in its capital structure. Okay, redeemable debenture. Okay, let's look at it. Redeemable debenture. Aristotle PLC has 13% redeemable debenture in its capital structure. Currently quoted at 109 naira. Interest on the debenture is about to be paid. And debt will be redeemed, in 6 years time. Required to calculate the company's cost of debt. Okay. So that's the question. So this is the question. It says Aristotle PLC has 13% redeemable debenture in its capital structure, currently quoted at 109 naira. Interest on the debenture is about to be paid, and debt will be redeemed in 6 years' time. Required to calculate the company's cost of debt. So in this question, we are specifically told that this debenture is what is redeemable, but you need to do what? Ask yourself that question again. Is it truly a redeemable question? Is this question truly a redeemable question? And what is the yardstick that we told us? That is, must have, for the debenture to be redeemable, must have the date of purchase and the date of redemption. Now, do we have the date of purchase and the date of redemption here? Let's look at it. The redeemable debenture in its capital structure currently quoted at 109. 109 is what? Is market price of debt. Interest on the debenture is about to be paid. Looking at it again, look at it. Interest on the debenture is about to be paid. That is, this price of debt is what? Come in. This price given to us is come in price. That is, there's an element of what? Of interest in this price. So therefore, we need to adjust the price to become SN because it's the SN price we need to use. And the debenture will be redeemed in 6 years' time. Yes, we have the date of redemption. We have the date of redemption, that is in 6 years' time. Well, what is the date of purchase? It is not specifically stated, but if you look at this word here, and debt will be redeemed in 6 years' time. That is to say, we know today is what? Is the date of purchase. And we say in 6 years' time, it is we are counting from today. Yes, we have the date of purchase here. We have the date of purchase here. So in 6 years' time, today is the day of purchase and 6 years' time date of redemption. So let's quickly look at it. So therefore, this question is what? It is a redeemable debenture question. Now, how do we now solve it? We said the formula to use under a redeemable question is what? Is the higher formula. So therefore, KD, which is our IRR, is equal to A A plus NPV at the lower rate all over NPV at the lower rate minus NPV at the higher rate minus NPV at the higher rate. So everything B minus A. Everything is B minus A. And this open a bracket. This bracket means multiplication. Now, this is the formula we should be given. Like we said in some of our videos, that this formula normally change. You see it changing to positive. Why? Because most of the time, the NPV at the higher rate mostly give us negative NPV. So minus negative times negative give us positive. That's why you see most of the time might see a positive sign here. Or the normal formula is what is this. Okay, let's now look at, let's set our table. Setting our table, we have here, we have item, we have cash flow, we have cash flow, we have cash flow, we have discounting factor, DF, discounting factor, DF means discount factor, we have present value. Okay, now here, we start with your year 0, which is what? The year of purchase. Year of purchase, that is current value. Purchase price or current value. Item, current value. Current value. So what is the cash flow? That is the price then. The price at which you bought it. Now, measure it, look at it. So what value are we going to have here? And the company currently quoted at 1 naira. Interest on the debenture is about to be paid. Look at it. Interest on the debenture is about to be paid when you bought this thing. When you bought this debenture, they are about to do what? The company is about to pay the interest on the debenture. By that, therefore, this element, this price that seen here is inclusive of what? Of the interest. The cum int. So therefore, we need to adjust it to the what? To S int. Let's even do the adjustments here. So cum int price, the cum int price is what? Is equal to 109. So what about the interest? The interest is what? 13. So what do we have? That is 96 naira. Well, 96. So the exit price now is what? The 96. So that is the price we are going to use under our what? Under our what? Cash flow, 96. 96. Mind you, this price you are seeing here is an investment, is money going out, is an outflow. This is what we expended in buying this and debenture. So it's an outflow, it's going out, so it will be in the jacket. Now, discount factor. What discount factor are we going to use here? Because we need to discount it. We need to discount this debenture. We need to discount it. We need to use the discount factor to discount it. Discount factor is a function of what? Time value of money. You are putting into consideration time value of money. So when you are investing now, you get 0 to a discount factor. So what discount factor are we going to use? Discount factor, are we given in the question? You are not given any discount factor in the question. In that wise, if you are not given any discount factor in the question, here in our own country, Nigeria, the peg rate of what? Of the interest rate is what? Is 10%. So you need to do what? If you are not given the discount factor in the question, just use 10%. You are not given a discount factor to use in the question, use 10%. Or any percentage you are going to use, please state it. Let us know the reason why you have used the percentage, please. So here, let's assume the discount factor is 10%. In the case where you are not given, just use what to the peg rate in which it was pegged in your own country. So here we are using 10%. Any rate you are going to use, any assumption you are making, just put the assumption there. Okay, so here we are using 10%. So discount factor in year 0. For any year 0, discount factor is always 1, because it's in year 1. The 1 error now is 1 error now, but tomorrow your 1 error will not be what the same as 1 error tomorrow. But now it says your 1 error. So you have it at 96. You multiply to get that this cash flow multiplied by discount factor, you have this. So subsequently, what are you expecting? You are expecting, so what is the next thing is coming after your investment? What are you expecting? You are expecting your return on investment, which is the interest. You have invested, what next are you expecting? You are expecting your interest, which will flow for how many years? Which will flow for, because you are going to, it will be redeemed in 6 years. So the interest, you are going to receive your interest for 6 years. So let's do the cumulative discount factor. So years 1 to 6, you are going to receive what? What are you receiving? Interest. Okay? Interest. You are receiving interest. So what is the interest rate you are receiving? What is the interest you are receiving here? The interest given to us is 13. 13. So this is the interest. 13%. 13% of 100 is what still comes back to 13. What is now the cumulative discount factor for years 1 to 6? Cumulative discount factor for years 1 to 6. So let's press our calculator to determine that. Cumulative discount factor for years 1 to 6 is what? 4.355. 4.355. So I've said it. I'm still going to do a video. On how to compute your cumulative discount factor. I will still show how you want to compute it. But now to compute it, this is the we still show the formula on how to compute it. So but now as when the discount factor is what? 4.355. So what is the present value? PV means present value. PV means present value. Okay. So 13 multiplied by 13 multiplied by 4.355. You have 56.615. 56.615. Okay? So what next is coming in? After year 6, what are you doing? You are going to redeem. So year 6. So redemption value. Yes. So at what value are you going to redeem it? Look at it. Currently, put the interest on the venture is about to be paid, and the venture will be redeemed in 6 years' time. In 6 years' time, okay, let's add something there. The venture will be redeemed in 6 years' time. Okay, in 6 years' time. Okay, at a premium, let's include it here. In 6 years' time, at a premium, let's include the premium. At a premium, let's make the question very solid. At a premium of, let's say 4%. Yes, let's do it that way. At a premium of 4%. So let it be detailed. At the premium of 4%. So redemption value. So what is the value are we going to redeem it? So now say it will be redeemed in 6 years' time at a premium of 4%. What do you mean by premium? Premium is above the normal price, and it says premium. The element which is above the normal price. And what is the normal price of the debenture? The nominal value of the debenture. We have said it here that the nominal value of the debenture is 100 naira. 100. So therefore, at the premium of 4%, that is 4% of 100. 4% of 100. The nominal value of the debenture, as we have said, is what? Is 100. So when it will now be redeemed at a premium of what? Of 4%. It means the debenture has the market value of the debenture has increased, so they are giving it back to us as a premium of what? 4%. So you now do what? 104. 104, which is an element of what? Of the nominal value and the 4%, the premium. So what is our discount factor for year 6? This one factor for here is what? 0. At 10% to at 10%. At 10%. Now be what? 0.564. 0.564. So multiply it. Press your calculator. Press your calculator. Calculator. 104 multiplied by 0.564. 564. What do you have? 58.656. 58.656. So you sum it up. You sum it up. What do you have? Sum this one, this plus this plus this. So what do you have? The result you are going to have is what? 19.271. 271. So 56. That's the it. Plus 56.615 minus 96. 19.271. Yes. 19.271. Mark you have gotten just one. This one what you have now is what? Net present value. This present value after you have booked the cost is now what? NPV. Net present value. Net present value. So, having got this, we need to compute the other leg of it, in which you are going to have the negative NPV at the higher rate. So this is one rate, so we need to do what? Now that we have the positive NPV now, this is what positive NPV we have now, so we need to compute a second NPV in order for us to have what? A negative NPV, because when you said internal rate of return, it is the rate that equates the break-even point. So we need to calculate that rate, that point. So we need to calculate the second leg of it. We need to calculate the second part of it. So the answer we got here is what? 19.271. So let's quickly look at it. What time goes against us? Let's quickly look at it. Now we have this now. Let's rub this. In order for us to do what we need to have it. That will be not space. That's rubbing this. So let's let this one go. But take note of the answer we have got in there. So let's now have this. Let's have it. So let's now assume the rate. What is the second rate you want to use here? The second rate, we have used 10%, which we have positive NPV. For us to have a negative NPV, you need to do what? So we need to increase the rate. We need to increase the rate. We need to increase the rate. So let's now say 50% of the former rate. The former rate was 10%, 50% now what? Plus 1 point. I mean 50% was the former rate, so that was 15%. So okay, let's now use 50%, whether we are going to have a negative NPV. PV, yes. Okay, now 50%, still here 0, we see are still going to have 1. So multiply it by this by this, we have what? 96. Okay, so your interest, okay, so what is our cumulative discount factor at 15%? 15% to give us what? 3.784. At 6%, it will give us 0.432. So let's quickly multiply it. So 13 multiplied by 3.784 rather, 3.784, we have 49.192. 49.192. So 104 multiplied by 104 multiplied by 0.432. 432, we have 44.928. 44.928. So what do you have? Sum it up. What do you have? 44.928 plus 49.192. 49.192. Okay, minus 96. We have negative 1.88. Okay, you can see now that we have a negative NPV here now. We have a negative NPV. So let's now apply this formula. Let's now apply the formula. We have our higher rate, we have our lower rate, we have our positive NPV at the lower rate, we have NPV at the higher rate. Please. This is NPV at the lower rate. This is lower rate, we already have it, we should compute at 10%, and this is NPV at the higher rate. Is it here? So let's quickly look at it. Let's compute it. Let's quickly look at it. So what is our A? We have said in our previous video, we have defined this concept in our previous videos. So A is the lower rate. So what is the lower rate in the question, which is what? 10. 10 plus NPV at the lower rate. What is NPV at the lower rate? We compute it to be 19.271 all over NPV at lower rate 19.271 minus this minus sign. What is the NPV at the higher rate we got? We compute that to be 1.88. So minus 1.88. So minus 1.88. Open the bracket. The bracket means multiplied by B is what? Higher rate. What is the higher rate? 15 minus 10. Lower rate. A is the lower rate minus 10. Now we can see the reason why most of the formulas will be having what? Positive here. When we only have positive is because if the higher NPV, please note. If the higher NPV, if the higher rate give us negative sign, so if you still minus times minus, you still have what? Change to addition to plus. So 10 plus 19.271 all over 19.271 plus 1 minus that's plus 1.88 is equal to 21.151 the bracket 50 minus 10, we have it as 5. So therefore now we got 10 plus, okay, so 19.271 divided by 21.151. What is the answer? Multiplied by 5. That is 4.55. 556 anyhow is equal to, so 10 plus this, you have 14.556%. So that is it. That is the fact on that. That is the question on what? On redeemable debenture. So it's very simple and very straightforward. So that is it. Please, you can watch our previous videos for more explanation on the formulas. And I think this one too is self-explanatory, but it still requires more. If you still need more explanation of it, look at watch our previous videos, and you shall be satisfied with the question, the explanation of the formula. You shall appreciate this cost of debenture very well. And besides, if you still have further questions, you can put it in the comments, under the comments. You sign in the comments, and you shall do what? I will be glad to do what to receive your comment and reply as immediately I receive it promptly, and I'll go to reply promptly. So thank you. This comes to the end of this class. So watch out for our subsequent videos in which we shall be talking about marginal cost of capital. We'll also be talking about weighted average cost of capital. We have said the theoretical aspects. We are going to do what? See the computation on the weighted average cost of capital, marginal cost of capital, and numerous topics. We are still going to, this is just the tip of the iceberg. We are still going to do what? Give us more and more at least strategic financial management. But at the end of the day, you shall be what? A manager on your own, to drive your own business and make good decision which is going to do what? Move the company forward. And besides, you shall be giving us other resources on how to be financially independent, because we need to do what? We need to equip ourselves. One stream of income is not enough, so I'll be giving us tips, success nuggets, financial independence nugget, and so many interesting discussions will be coming on this YouTube channel. So keep on watching. If you have not subscribed to our YouTube channel, kindly click on the subscribe button for you to know what to receive updates of any videos in which I've posted. So thank you and God bless.